A very good morning to all my dear students. Welcome to 12th Standard Accountancy. I am Thomas Matthew, your teacher for the day. In my previous video class, we have learned how to make a profit and loss appropriation account. And I told you the purpose of preparing a profit and loss appropriation account is to find out the amount of divisible profit or distributable profit. The meaning of divisible profit is the profit amount that should be divided among the partners in the agreed ratio is called divisible profit. To find out the amount of divisible profit, the firm has to prepare an account which is called profit and loss appropriation account, which is always starting either with a net profit or with a net loss. Then the various appropriations like interest on capital, salary, commission, interest on drawings, all these items are taken to profit and loss appropriation account to find out the amount of divisible profit. And today in my class, I'll teach you another account which is called partners capital accounts. If it is a sole proprietorship, last year we have learned we have to make only one capital account because there is only one owner. And the capital account records all the transactions which are made by the proprietor with the business. And if it is a partnership firm, actually, the firm has to prepare separate capital accounts for different partners to record the various transactions of each partner with the firm. The common examples of transactions made by the partner with the firm are, say for example, capital introduced, capital withdrawn, interest on capital, salary, commission, divisible profit, and all these are examples of various transactions made by each partner with the firm. And for recording the various transactions made by each partner with the firm has to maintain. And for maintaining partners capital account, there are two methods. And the first one is called fluctuating capital method, and the second one is called fixed capital method. Once again, I repeat, for maintaining partners capital account, there are two methods. One is called fluctuating capital method, one is called fixed capital method. Now I will explain the first method of maintaining partners capital account, which is called fluctuating capital method. When we look at the heading fluctuating capital, simply means the capital balances of the partners are going to fluctuate due to the various transactions like interest on capital, salary, commission, etc., etc. Right? So when the partners' capitals are fluctuating, the meaning of fluctuating capital is the capital balances of each partner is going to fluctuate due to the various transactions made by the partner with the firm. Say for example, when the amount of interest on capital is provided by the firm to the partner, definitely their capital balances are going to increase. One more example, when the firm is charging interest on drawings from the partners, their capital balances are going to decrease. So, due to each transaction made by the partner with the firm, their capital balances are going to fluctuate, and this method of maintaining partners capital account is called fluctuating capital method. When you prepare the partners capital account according to the first method, which is called fluctuating capital method, I told you before, for maintaining partners capital account, actually there are two methods. One is called fluctuating capital method, one is called fixed capital method. Okay, so when we are maintaining partners capital account according to fluctuating capital method, actually now I want to explain the format of partners capital account according to the fluctuating capital method. So please have a look at the first item. I'm starting with my partners capital account is starting with opening balances of capitals. And for the opening balance of capital, on the credit side, what I am writing is by balance brought down. Okay, and the opening balance of capital is taken to the credit side because capital has got a credit balance. That is why the opening balance of capital is taken to credit side. and the amount of opening capital is taken separately for, say for example, there are two partners and the amount of opening balance of capital is taken separately for A and B, like this. Okay, so when we have to maintain the partners capital account according to fluctuating capital method, this is the format of partners capital account, and the various columns provided are, the first column stands for particulars. I am providing a separate column for A, I am providing a separate column for B. Okay, and before I told you, the firm has to maintain capital accounts separately for each partner. Why it is prepared separately? Because each partner has separate transactions with the firm. That is why the firm has to maintain partners capital account separately for each partner. And if it is fluctuating, my partner's capital account is always starting with opening balance of capitals. Opening balance amount is taken to credit side separately for A and B, because capital account has got a credit balance. I hope it is clear for you. Okay, the next item to be taken to partner's capital account is, please have a look at the second item, by cash or by bank. Okay, when a partner is investing additional capital into the firm, you have to think about what is the journal entry for that. Okay, so when a partner is investing additional capital into the firm, the journal entry should be cash account or bank account, debit to partner's capital account. And then in the partner's capital account, the posting is by cash or by bank. Okay, and the amount of additional capital invested by A and B has to be shown separately, like this, please. Okay, what is the next item to be taken to partner's capital account? If it is fluctuating, is, look at this item, by interest on capital. Now the question arises, why interest on capital is taken to credit side in a partner's capital account? Okay, so when the firm is allowing interest on capital to a partner, think about what is the journal entry for that. So interest on capital for the firm, it is an expense, and the rule says every expense account has to be given debit. Then what is the entry? Interest on capital account, debit to partner's capital account. Okay, and why we are crediting partner's capital account? Because when the firm is providing interest on capital to the partner, their capital balances are going to increase. When capital is increasing, liability is increasing. That is why partner's capital account is given credit in the journal entry, and the posting will come by interest on capital in the partner's capital account if it is fluctuating. Okay, and the amount of interest on capital is taken separately for A and B, like this. Look at the next item, by salary, and the amount is taken separately for A and B, by commission, and the amount is taken separately for A and B. And now please have a look at this item. When I am writing by profit and loss appropriation account in the partner's capital account, if it is fluctuating, what is the meaning of this item? Last video class, we studied about an account which is called profit and loss appropriation account. What is the purpose of preparing profit and loss appropriation account is to find out the amount of divisible profit, and that divisible profit amount should be transferred to partner's capital account, and if it is a profit, that amount has to be transferred to the credit side in a partner's capital account if it is fluctuating. So when I am writing by profit and loss appropriation account, this is the amount of divisible profit, and this amount should be entered separately for A and B, like this. Okay, so please have a look at all the items which are appearing on the credit side actually in a partner's capital account. If it is fluctuating, we are starting with the opening capital balances. Then what is taken is additional capital is taken, interest on capital is taken, salary amount should be taken, commission amount is taken, divisible profit amount is taken, and all these amounts are taken separately for A and B, because before I told you the firm has to prepare partner's capital account separately because each partner has separate transactions with the firm. And if these many points are okay for you, I'll go to the debit side, and please look at the first item. Okay, so two drawings. When the amounts are withdrawn by the partner against a profit, and that will decrease the capital of the concerned partner. That is why drawings amount should be taken to debit side in a partner's capital account if it is fluctuating, and here the amounts are taken separately for A and B, like this. And please look at the next item, to cash or bank, drawings against capital. And here the point that you have to understand is drawings are classified into two categories. And the first category is called drawings against profit, and the second one is drawings against capital. When I am withdrawing, when the partner is withdrawing his own capital from the firm, it is called drawings against capital. And if the partner is withdrawing his share of profit from the firm for his private use, that amount is called drawings against profit. Okay, and whenever there is a drawings against profit or whenever there is a drawings against capital, both will decrease the capital of the concerned partner. That is why these two drawings are recorded on the debit side in a partner's capital account if it is fluctuating. Right? Look at the next item, please. 2. Interest on drawings. I told you so many times in the class what is the meaning of interest on drawings. This is an amount of interest charged by the firm from the partner, correct, and which will reduce the capital balances. That is why interest on drawings amount should be entered on the debit side in a partner's capital account if it is fluctuating. Okay, look at the next item. 2. Profit and loss appropriation account. The firm has to make an account which is called a profit and loss appropriation account to find out the amount of divisible profit or divisible loss. And if there is a divisible profit, actually that amount should be taken to credit side in a partner's capital account. And if there is a divisible loss, actually that amount should be taken to debit side in a partner's capital account if it is fluctuating. Okay, and once again, please look at all the items which are coming on the credit side as well as the items which are coming on the debit side. Okay, after entering all these amounts, separate total has to be taken for A and B. I am taking the total separately for A and B, and the same total should be written on this side also, and then difference amount should be taken between this total and these many amounts. Actually, I am getting the difference amount separately for A and B, and these amounts are to balance carry down. Simply means these are the closing capital balances of A and B at the end of the accounting year. Okay, and this is the complete format of partner's capital account if it is fluctuating. And once again, I won't repeat the main points for you. Our partner's capital account is always starting with opening balance of capitals separately for A and B. Additional capital amount is taken, interest on capital amount is taken, salary amount is taken, commission amount is taken, divisible profit amount is taken, and you have to correctly understand these many items which are appearing on the credit side in a partner's capital account will definitely increase the capital balances. Okay, and please have a look at the debit side items. 2 drawings means drawings against profit, 2 cash or to bank drawings against capital, 2 interest on drawings, and if there is a divisible loss in the profit and loss appropriation account, that loss amount should be taken to debit side in a partner's capital account if the capitals are fluctuating, and all the items which are appearing on the debit side will decrease the capital balances of the concerned partners. Your partner's capital account, if it is fluctuating, always we are starting with the opening capital balances, ends with closing capital balances separately for each partner, and this is the format of partner's capital account if it is fluctuating. So I hope the format of fluctuating capital method is clear for you. And as I told you before, to maintain partner's capital account, actually there are 2 methods. One is called a fluctuating capital method and one is called fixed capital method. In detail, I explained the format of partner's capital account. If it is fluctuating, I hope this topic is clear for you. Now I will go to the next topic. For maintaining partner's capital account, there are 2 methods. One is called fluctuating capital method. That method is complete now. I'll be starting with the next method, which is called fixed capital method. And when we look at the heading, what is the meaning of fixed capital? Okay, fixed capital of a partner means the capital amount which is introduced by a partner remains fixed year after year unless he introduces additional capital or he withdraws a certain amount from his capital, and this capital is called fixed capital. Once again, I repeat, fixed capital means the capital which is invested or introduced by a partner remains always fixed year after year unless he introduces additional capital or he withdraws a certain amount from his capital, and this capital of a person is called fixed capital. What was my previous method? Fluctuating capital method. And if you are following fluctuating capital method, the student has to prepare only one account which is called a partner's capital account, and all the adjustments are taken to the same account. But if the question says prepare partner's capital account according to fixed capital method, we have to prepare 2 accounts. One is called partner's capital account, one is called partner's current account. I just want to repeat that point once again for you. If the capitals are fixed, What is the meaning of fixed capital? The capital introduced by a partner remains fixed year after year unless he introduces additional capital or he withdraws a certain amount from his capital, and this capital is called fixed capital. And the student has to maintain the capital of the partner fixed every year. Okay, and if the fixed capital method should be followed, you have to prepare two accounts. One is called partner's capital account, one is called partner's current account. Now you have to think why we have to prepare a partner's capital account. Oh, if the capitals are fixed, you have to prepare a partner's capital account to show and to record only the transactions which are connected with capital. Okay, and a small point for you, which are the various examples of transactions related with capital only. One is capital invested, or we can say the opening balance of capital. And the second item which is related with capital is additional capital which is introduced by a partner is an example of a transaction related with capital. Okay, one more example of a transaction which is related with capital is if an amount is withdrawn by a partner from his capital, that is also an example of a transaction related with capital. So, when the capitals are fixed, you have to prepare two accounts. One is called fluctuating capital method. That method is already finished. Okay, and the second one is called fixed capital method. When we have to follow the fixed capital method, you have to prepare two accounts. One is called partner's capital account, and the second one is called partner's current account. And why we have to prepare a partner's capital account? A partner's capital account is prepared separately when the capitals are fixed only to record the transactions related with capitals. And the common examples of transactions related with capital are opening balances of capital, additional capital introduced, capital amount which is withdrawn by the partner. These three are the examples related with capital. Only for recording transactions related with capital, we have to prepare a separate account which is called partner's capital account if the capitals are fixed. Now the question arises, why we have to make a special account which is called partner's current account? You have to prepare an account which is called partner's current account when the capitals are fixed to record all other transactions other than opening balance of capital, additional capital introduced, capital amount which is withdrawn, and for showing all other transactions, say for example, interest on capital, interest on drawings, drawings out of profit, salary, commission, divisible profit, and for showing all other transactions other than opening balance of capitals, additional capital introduced, capital which is withdrawn, you have to make a special account which is called a partner's current account when the capitals are fixed. In short, for maintaining partner's capital account, there are two methods. One is called fluctuating capital method. And if it is fluctuating capital method, you have to prepare only one account which is called partner's capital account, and all the items are taken to the same account. And when the capitals are fixed, you have to prepare two accounts. One is called partner's capital account. What is the purpose of making partner's capital account when the capitals are fixed? To show all the transactions which are related with capital. Okay, what is the purpose of preparing partner's current account when the capitals are fixed? Answer is very simple. The purpose is to record all other transactions like interest on capital, salary, commission, divisible profit, drawings, interest on drawings, etc. When the capitals are fixed, you have to prepare another account which is called partner's current account. If the capitals are fluctuating, make only one account which is called partner's capital account, and if the capitals are fixed, you have to prepare two accounts. One is called capital account, one is called current account. I hope my explanation is clear for you. Okay, now I will explain the format of a partner's capital account if the capitals are fixed. Okay, and here also my partner's capital account is starting with, look at the first item, by balance brought down. Okay, so when I am writing by balance brought down on the credit side in the partner's capital account, if capitals are fixed, these are the opening balances of capitals separately for A and B. Okay, what is the meaning of this item by bank? Somebody has introduced additional capital. Additional capital is a transaction connected with capital, and this amount has to be entered in the partner's capital account if the capitals are fixed. Okay, look at this item, to bank. What is the meaning of this item? These are the drawings made by the partner out of his capital. Since it is connected with capital, this amount should be entered in partner's capital account when the capitals are fixed. Items are complete. So when you prepare the partner's capital account, when the capitals are fixed, the number of items which are taken to partner's capital account is very less actually. And which all items are taken? One is the opening balance of capital, additional capital if any, and if there is a drawings out of his capital, finished. And then you find out the closing capital separately for A and B. Then the partner's capital account is complete if the capitals are fixed. Look at the format very carefully and try to understand what is the meaning of each and every item in the partner's capital account when the capitals are fixed. Now what I will do, okay, I will explain the format of partner's current account when the capitals are fixed. I told you before, when we are following the fixed capital method, we have to prepare two accounts. One is called a partner's capital account. I explain partner's capital account. Now I will explain the format of a partner's current account. Same like a partner's capital account, my partner's current account is also starting with opening balance, and the amount is taken separately for A and B. As I told you before, interest on capital amount should be taken to partner's current account credit side when the capitals are fixed. Okay, commission amount should be taken to partner's current account when the capitals are fixed. Salary amount should be taken to partner's current account when the capitals are fixed. Divisible profit amount should be taken to partner's current account when the capitals are fixed. And these many items are taken to credit side in a partner's current account when the capitals are fixed. And here also you can see that the amounts are taken separately for A and B. Okay, so please have a look at the items one by one on the debit side. If there is a debit balance in partner's current account, that is taken to debit side. What is the meaning of this second item? To drawings. Whenever the partner makes a drawings out of profit, that amount should be taken to debit side in a partner's current account when the capitals are fixed. Okay, and say for example, in the profit and loss appropriation account, if there is a divisible loss, that is also taken to debit side in a partner's current account. Then the next step is separate total should be taken for A and B. The same total should be written on this side also. Difference amount should be taken separately, and the difference amount is to balance carried down separately for A and B like this. And this is the complete format of partner's current account when the capitals are fixed. Okay, and for maintaining partner's capital account, there are two methods. One is called a fluctuating capital method. One is called fixed capital method. Okay, and if the capitals are fluctuating, you have to make only one account, which is called partner's capital account. And if the capitals are fixed, you have to prepare two accounts. One is called a partner's capital account. One is called partner's current account. I explained both the accounts format in detail, and please try to understand this topic very correctly. And for the examination, don't make a mistake, please. Now I will explain one question based upon partner's capital account as well as profit and loss appropriation account. Okay, I just want to read the whole question for you. There are two partners A and B, and their capitals were rupees 60,000 and rupees 20,000 respectively on 1st of April 2018. Net profit before taking into account the provisions of the deed for the year ended 31st March 2019 was rupees 24,000. Okay, and this is the amount of net profit as per the profit and loss account. Then the question says the partnership deed provided for the following. First adjustment, the partner B is entitled to a salary of rupees 6,000 per annum, and the second adjustment says interest on capital is allowed at the rate of 6% per annum. Interest on drawings is to be charged at the rate of 5% per annum. The drawings of the partners A and B were 6,000 and rupees 4,000 respectively, and the interest on drawings for A being rupees 200 and for the second person B 100. The question says prepare the profit and loss appropriation account and also prepare the partners capital accounts if they are fluctuating and if they are fixed. Okay, I will explain the whole answer for you. First, I will start with the profit and loss appropriation account. Look at the heading, profit and loss appropriation account for the year ended 31st March 2019. In my previous class, I told you the profit and loss appropriation account is starting always with the amount of net profit. Net profit is taken from the profit and loss account. Net profit amount should be taken to the credit side in a profit and loss appropriation account. Net profit amount is taken from profit and loss account. That is why our profit and loss appropriation account is starting with by profit and loss account. Okay, and the amount of net profit is taken directly from the question, and the amount of net profit is 24,000 rupees. I think the first item is okay for you, right? Please look at the second item on the credit side in a profit and loss appropriation account by interest on drawings. Okay, interest on drawings amount should be taken to credit side in a profit and loss appropriation account, because for the firm interest on drawings is an income, and here the amounts are recorded separately for A and separately for B. And the amount of interest on drawings are taken directly from the question. For A, the amount is rupees 200, and for the second person B, the amount is rupees 100, and the total amount which is taken to the outer column for interest on drawings is rupees 300. Okay, and once again I repeat, as far as the profit and loss appropriation account is concerned, it is always starting with the amount of net profit. Okay, and the amount of net profit is taken from the profit and loss account. So I am starting with by profit and loss account. And the profit amount which is taken directly from the question is 24,000 rupees. Next item to be taken to credit side in a profit and loss appropriation account is by interest on drawings. Interest on drawings amount should be taken to credit side in a profit and loss appropriation account, because from the viewpoint of the firm it is an income, and the amounts are taken separately for A and B, and the amount which is taken for A is rupees 200, and the amount which is taken for B is rupees 100, and the total which is taken to the outer column is 300. Now look at the items which are taken to debit side in a profit and loss appropriation account. Look at the first item, to interest on capital. Okay, interest on capital amount should be taken to debit side in a profit and loss appropriation account, because for the firm interest on capital is an expense. Okay, and the amount is calculated separately for A and B at the rate of 6% on their capitals, and then interest on capital for A comes to rupees 3,600, and the amount of interest on capital for B comes to 1,200, and the total amount of interest on capital taken to the outer column is 4,800, like this. Okay, and what is the next item to be taken to debit side in a profit and loss appropriation account is to salary, and the question says only the second partner, who is called B, is eligible for a salary amount of rupees 6,000 per annum. So 6,000 is the annual salary, that amount is taken directly, and salary amount should be taken to debit side in a profit and loss appropriation account, because for the firm salary is an expense. Okay, after writing these many items, my profit and loss appropriation account is complete. Now the total has to be taken. When you add up these two amounts, what you will get is 24,300. Okay, and the same total should be written on this side also. Then from the debit side, add up these two amounts, subtract, difference amount is calculated. I am getting a difference amount of 13,500 in the profit and loss appropriation account, which is called divisible profit. Okay, and the amount of divisible profit is coming to 13,500, and this amount has to be shared between A and B. And the question says, when we look at the whole question, the profit sharing ratio is not given. Okay, so when the profit sharing ratio is not given there in the question, we can assume that they are equal partners. Then the divisible profit amount of rupees 13,500 should be shared between A and B in the ratio 1:1. Then A is getting a share of 6,750, and B is also getting a share of 6,750 from the divisible profit. Then profit and loss appropriation account is complete. I hope it is clear for you. Now I will explain the second account, which is called partners capital account, and this is the partners capital account prepared according to fluctuating capital method. So please look at the first item. I am starting with the opening capital balance by balance brought down, and the amount which is taken separately for A is 60,000, and the amount which is taken separately for B is 20,000. Next item to be taken to partners capital account, if it is fluctuating, by interest on capital. The amount which is taken for A is 3,600, and the amount which is taken for B is 1,200. Okay, next item to be taken to partners capital account, if it is fluctuating, by salary. And the question says only the second partner, who is called B, is eligible for a salary, and the amount which is 6,000 is taken only to B's column. Okay, look at the next item, by profit and loss appropriation account. When I am writing by profit and loss appropriation account, what is the meaning is, this is the amount of divisible profit taken from the profit and loss appropriation account, and from the divisible profit, A is getting a share of 6,750, and B is also getting a share of 6,750, and these many items are recorded on the credit side in a partner's capital account if the capitals are fluctuating. I hope these items are okay for you. Clear? Okay, and once again I repeat, interest on capital will increase the capital balance. Salary amount will increase the capital balance. Divisible profit amount will increase the capital balances of the partners. Anything which increases capital is recorded on the credit side in a partner's capital account if capitals are fluctuating. Okay, now I just want to explain the various items which are appearing on the debit side in a partner's capital account if the capitals are fluctuating. Please look at the first item, 2 drawings. And these amounts are taken directly from the question, and the amount of drawings which is taken for A is 6,000 and the amount of drawings which is taken for B is 4,000. Okay, next item to be taken to debit side in a partner's capital account if it is fluctuating, that is 2 interest on drawings. Okay, and the amount of interest on drawings is also taken directly from the question, and the amount which is taken for A is rupees 200 and the amount which is taken for B is 100. What is the speciality of these 2 items? And these 2 items will reduce the capital balances of the partners. Any transaction that reduces the capital balances of a partner should be taken to debit side in a partner's capital account if the capitals are fluctuating. Okay, last step is separate total should be taken for A and B, please. Okay, and the same total should be written on the opposite side also. Difference amount should be taken, and the difference amount I am getting in partner's capital account is always to balance carried down, and the closing balance of capitals are calculated separately for A and B like this. And this is called my partner's capital account if the capitals are fluctuating. Okay, and please have a careful look at the note I am writing for you. Please, if partner's capitals are fluctuating, prepare only one account called partner's capital account, and all the transactions are entered into the same account. Okay, and the capital balances of the partners fluctuates with each transaction. Hence, this method is called fluctuating capital method. Okay, and these are the steps to be taken to prepare the partner's capital account if the capitals are fluctuating. This method is complete, finished. Okay, now I will explain the partner's capital accounts according to the second method, which is called fixed capital method. I told you before, when we are following the method which is called fixed capital method, we have to prepare 2 accounts. One is called partner's capital account, one is called partner's current account. Okay, as far as this question is concerned, in the question, when we prepare the partner's capital account, if the capitals are fixed, I am starting with the opening capital by balance brought down, and the amount which is taken for A is rupees 60,000 and the amount which is taken for B is 20,000. And you can see that in the question there is no additional capital, there is no drawings from the capital, actually nothing else is taken to partner's capital account. I am just writing the opening capital as well as the closing capital. Okay, and why, say for example, interest on capital amount is not entered in partner's capital account. If I am writing interest on capital in the partner's capital account, their capitals are going to fluctuate. Okay, so if the capitals are fixed, what is the meaning of fixed capital? The capital which is invested by a partner remains always fixed year after year unless he introduces additional capital or he withdraws a certain amount from his capital, and this capital is called fixed capital. When we are following fixed capital method, we have to prepare 2 accounts. One is called partner's capital account. Inside the partner's capital account, you start with the opening capital balance, total is taken, and separate total is taken for A and B. Same total on this side also, difference amount is taken, and that amount is to balance carried down. One more speciality you can note is their opening capital and closing capital both are same because their capitals are fixed. So I hope my point is clear for you. Okay, now for showing all other adjustments in the question, you have to make the second account, which is called partner's current account. You can see that in the given question, lot of other adjustments are there like interest on capital, salary, divisible profit, drawings, interest on drawings, etc. And for showing all these adjustments, we are making the second account, which is called partner's current account. Please look at the items one by one. On the credit side, in a partner's current account, if the capitals are fixed, okay, I'm starting with by interest on capital. The amount which is taken for A is 3,600 and the amount which is taken for B is 1,200. By salary, the amount is taken only for B, 6,000. By profit and loss appropriation account, this is the amount of divisible profit, taken from the profit and loss appropriation account, and the amount which is taken for A is 6,750 and the amount which is taken for B is 6,750. Okay, now look at the items which are taken to debit side in a partner's current account if the capitals are fixed. The first item, 2 drawings, amount for A is 6,000, amount for B is 4,000. 2 interest on drawings, and the amount which is taken for A is 200 and the amount which is taken for B is 100. Then you will find out the closing balance. 2 balance carried down, and the closing balance in current account has to be calculated separately for A and B. Separate total is taken for A and B. Difference amount is calculated, and the difference amount is always taken 2 balance carried down. Okay, what is the meaning of this 2 balance carried down is these are the closing balances separately for A and B, which is coming in partner's current account. Okay, a small question for you. I am getting the closing balance 4,150 for A and 9,850 for B. Is it a debit balance or a credit balance? Last year we studied when we prepare a ledger account, when the total of the credit side is more, the account is said to have a credit balance. And here in partner's current account, A and B has got totals more on the credit side. Correct, no? So their credit side total is more than the debit side total. Then their current account is having a credit balance. So in the partner's current account, I am getting a closing balance separately for A and B, and the closing balance which is coming in A's current account is 4,150, and the closing balance which is coming in B's current account is 9,850, and both are examples of credit balances in partner's current account because the total of their credit side is more. Okay, so when we are following the method which is called fixed capital method, we have to prepare 2 accounts. One is called partner's capital account, one is called partner's current account. I hope through my explanation the 2 accounts are okay for you. I'm just writing a note also for you. Look at this note, please. Okay, if partner's capitals are fixed, prepare 2 accounts. One is called a partner's capital account, in which enter only transactions related with capital, that is opening capital balances, additional capital if any, and capital withdrawn. Okay, and the second account that should be prepared is partner's current account is prepared to record all other transactions other than the above, like interest on capital, salary, commission, divisible profit, drawings out of profit, interest on drawings, etc. This is the purpose of preparing partner's current account when the capitals are fixed. Okay, and today my video class was about partner's capital account, and for maintaining partner's capital account there are 2 methods. One is called fluctuating capital method, one is called fixed capital method. Based upon this topic, I tried to explain one question also for you, the whole answer. Okay, and please copy this question and answer to the notebook. I hope the topics which are taken today in my video class is clear for you. Study the topics carefully and try to understand all the topics correctly, and have a good day. Thank you.